We've got a very good panel lined up here. Joining Patrick is Sean MacHale from EY. He can introduce himself in a moment a bit more. Eugene Wong, I'm absolutely delighted, joining us from Kuala Lumpur and giving a perspective from the ASEAN region and having been very active in the development of the taxonomy and transition planning in that region. And Stephen King, the Sustainability Solutions Vice President at Visa, giving a corporate perspective. And maybe I might actually start with you, Stephen, to give us a little bit of a sense how you navigate your planning through this challenge of estimates and proxies. The concept that we discussed, that a lot of this work is forward-looking. You now have to comply with EFRAG and ISSB standards. Where are you on the journey of delivering on this, and how do you think about forward-looking information?
Yeah, thank you very much, and grateful to be here. Our work on this topic not only focuses on our own four walls or what we do with our own operations and renewables, but us building solutions with partners in order to serve the entire ecosystem and our clients. With that work globally, we've noticed, I guess, a couple trends, one being, or commonalities really, one being that the expertise needed in order to tackle this topic is not always in-house, whether that's a bank or a merchant or a business. The second common thread is that the data that is needed to do this, and we'll talk about transaction data specifically in a second, is more than willing to be shared. And I think for the first time, we're seeing a topic in which there's a recognition that data sharing is going to be critical in order to enable them to not only meet regulations, but in order for them to fully understand this information, and not only because of Scope 3, but because of the how powerful data and information will be in order for tackling the challenge. But the part that distinguishes, which I think we'll touch on quite a bit during this panel, is how some parts of the world are seeing this as a challenge versus others are seeing it as an opportunity. And I think that's a positioning of business and the way they approach this, whether they see regulation as a cost and something that they need to deal with, or can they see this as an opportunity to change the way that they're doing business. So to your question specifically about transactional data and estimates, we believe that it's a very strong starting point for a journey to use money and the flows of money to estimate or get a first view of carbon. That we are working on in order to get a higher level of resolution, but also to join how money leads to activity. But again, that is information that is available in most systems already, and that is an initial first starting point, something that we work together with one of our partners, Plan A, to take from a transaction level down to carbon accounting, to give that first starting point on the journey that's going that they're doing. Just briefly on the point that I mentioned already around seeing it as a cost, if one takes reporting as a cost, the mindset is to either minimize that cost or to find the cheapest way to do it. I think if someone sees it as an opportunity to better understand how their business operates as it relates to environmental risk and environmental equaling credit risk, then they will make different choices in their supply chain. They'll make different choices in who they do business with and how they operate their own business, which will lead to increased performance. And with increased performance, then the allocation of resources, the buying of systems to do this becomes a different decision-making criteria than one when you're looking at it as just a procurement or a line item that you're trying to minimize within your business.
Thank you very much, Steve, for kicking us off on this. Before I pass on to you, Sean, just remind everybody, of course, in the audience that there's a Q&A function. I've already seen one question coming from Peter We will come back to that. I see it's primarily on C-band. I will come back to that maybe in the second session, but we otherwise will take that offline. But that may be over to you, Sean. You, of course, support clients in the climate change and sustainability development across different sectors. And I think it would be interesting to hear how companies that you work with are preparing for the implementation, and where you still see challenges, given that we're really still at a fairly early stage in the development of non-financial reporting. And I don't want to take Eugene's term away, but you always make, Eugene, the point that we're kind of challenged by looking forward rather than backward when we have to do our analysis on non-financial reporting. Over to you, Sean.
Thank you. So I think there's a couple of things maybe to unpick. I think the first thing is to look at it through the lens of moving from a voluntary reporting system to a mandatory reporting system in a regulatory setting. And obviously Patrick is on the panel, so just to complement the fantastic work that EFRAG has done. But from a European perspective, we can quite clearly see that when it was under voluntary reporting and sustainability reports, if I can be frank, were slightly creative writing exercises. That now is moving to a more regulated setting. Equally, there's rules being set around it. And when you look at some of the challenges, like data availability, that Stephen mentioned, I think the CSRD directive through the SRSs is going to address in a large part some of those data requirements. But at its very essence and core, really a lot of the disclosure requirements around reorientation capital flows. So what we think is really, really interesting, to Stephen's point, is that when companies look at this, particularly through the opportunity lens, what they're really doing is evaluating their business. And what they're able to do then through that is not only see savings and efficiencies, but also to spot opportunities as well. So I think from a European perspective, we've seen over a very, very short space of time, move from voluntary type disclosures, which may have been a little more, as I said, creative writing exercises, now into a much more strict format where the rule set is strict. And in that regard, it creates greater comparability. And it also gives us much more detailed insights. But I said at its very, very core is that component part to reorientate capital flows. And again, then it's understood that if you look at the likes of CSRD, it is designed to coalesce with the likes of EU taxonomy, which is in essence the classification system. And of course, then SFDR, which is the Sustainable Finance Disclosure Regulation, as the EU Green Deal package. Also, then what's of interest is how that interacts with global standards like ISSB. And to be fair, a huge amount of work has been done to create that interoperability between ISSB, TCFD, GRI, and so forth. And that's very, very welcome in terms of creating that kind of global baseline, so to speak. So I think, what we're really seeing from a client's perspective is looking at this now and through a different lens. And for those clients and many more moving towards it, they're moving to see the opportunity, because as it makes them look inwards and outwards, it brings whole new dimensions to actually the reporting exercise, but also to the business model.
Thank you, Sean. Maybe over to you, Eugene. Eugene is the Chief Executive Officer at the Sustainable Finance Institute for Asia. You've developed your own framework, which is not dissimilar to the European framework, but tailored a bit to the economy and the different, let's say, regional specificities. But you've decided to go down the voluntary route for now. And Sean just talked about the evolution from voluntary to a more formal framework as set out by Patrick. Where do you see the merits and challenges of remaining voluntary? And do you see a move potentially to move to a more mandatory framework? And the reason why I'm asking this is, if it's all voluntary, how do you make sure that the data collection is sufficiently robust and credible, particularly also when it comes to forward-looking information?
Thank you for that question. Thank you for having me. So first of all, I actually want to agree on the point about what we are using data for and what sort of opportunities that sustainability reporting can actually provide. And a lot of it really comes down to allocation of resources and making informed decisions. So if we look at a survey that was done by Standard Chartered Bank, more than 2/3 of MNCs surveyed actually said that they were looking at their own supply chain in helping reduce their carbon emissions, and the suppliers in 12 key markets for them would actually have the opportunity to share in 1.6 trillion worth of business if then they can remain part of the MNC chain. And more than that, they were actually prepared to spend more, with 45% of them saying that they'll pay a premium up to 7% on average for a product or service from a net zero supplier. And on top of that, MNCs are willing to offer preferred supplier status and also preferential pricing to their suppliers who can meet this. So clearly, what we can get is benefits from reporting and reporting correctly. But I'll just take a step back now and talk about how we have approached this. So right now in Southeast Asia, we don't have a mandatory reporting regime for the region as a whole. We do have, and that is because each of our members are sovereign states, and what we will have and what we will see is actual mandatory reporting, possibly at the member state level. But like what Patrick was saying, we don't have a CSRD type framework where companies that are listed or companies meeting a certain size in turnover, assets, or employees, or even non-EU companies who have a turnover of 150 million in EU have to comply with. What we do have is a requirement for listed companies in 6 out of our 10 member states to be reporting on the sustainability aspects. So the most commonly used framework right now is actually GRI, with the highest rate in Singapore at 99% and Vietnam at 65%. The rest range in between in the 90s and 80s. So it's a pretty much sort of accepted norm. And why do people do this on a voluntary basis? And I will add here that Singapore actually is the first country in our region who's proposing that there be mandatory reporting first for listed companies in 2025, including those that are not incorporated in Singapore but listed there, and also for larger companies exceeding 1 billion Singapore dollars in 2027. And the Philippines is saying that's considering looking at non-listed companies. But apart from that, we don't really have any form of mandatory reporting for companies as a whole. So why do companies do it? Well, the first, obviously, as I mentioned just now, is because the market discipline kicks in. And the supply chain is one of the examples of where market discipline kicks in. We also find that central banks are starting to impose environmental and social frameworks on the banks. So the banks have to take into consideration sustainability factors in providing loans. And also at the same time, what we do see is really investors, they are also looking at prospects and value. And this is really important because the market itself pushes our constituents to actually start with sustainability reporting. I do have to come back to a point you made just now about the forward nature of information, because really, when you look at the impact of sustainability and vice versa, as Patrick would say, on the world, then it's important to get forward-looking information, because it's not just about where we are today. Forward-looking information allows us to see who is standing still and who is moving towards a target and what that target is. It allows us to create scenario analysis, which is useful in many respects. And also, it allows better risk management, because you can see who's exposed, whether it be a supplier, a borrower, who is exposed to the vagaries of sustainable factors. So it is very important that we build this in. The second way we obviously try and instill sustainability reporting apart from true market discipline is also self-discipline, because I think companies also want to know where they're at. So if they have got the right data and that data is comparable and consistent, they're then able to evaluate for themselves, for both those charged with governance and management, whether or not they're on the right path and what else they have to do. And the third element, of course, how we can get people on board is through regulatory discipline. So we're starting to see a lot of regulatory discipline come in. I mentioned just now some of the central banks already imposing. ENS frameworks, and also we can see that a lot of regulatory tools are coming in as well. Say, for example, taxonomies, which also support the use of reporting. Very importantly, I have to say that the companies in Southeast Asia need to transition. There's 70 million MSMEs, and recently the capital market regulators came up with a transition finance guidance. Now, obviously, in creating a transition finance pathway, a lot of forward-looking information is needed. But companies need to come up and do this because they actually need to be able to move forward to restructure their operations and their technology to transition, to meet, well, simply to survive, and secondly, to access capital. And what we found when we actually talked about transition pathways is a lot of the businesses and users of transition pathway information came to us and said, look, we used to talk about feedback, but feedback isn't important anymore now. We're looking at forward information. So we're looking at feed forwards into what we're doing. And of course, I think this, Nick, is what you're referring to. So we, in Southeast Asia, although it's voluntary, the coming together of market discipline, self-discipline, and regulatory discipline helps push the reporting agenda.
Thank you very much, Eugene. And I like your point about the role of supervisors enforcing, and thanks, we were just together in the Middle East 2 weeks ago doing a roundtable exactly on that issue. Patrick, listening to your fellow panelists, I want to come back to you and just also ask you, you of course build in certain possibilities about expectations about forward performance, opportunities as you refer to them, not just the risks, but it's hard to sometimes quantify opportunities. And you also recognize that the industry, that the economy is on a transition pathway. Therefore, we have to use a lot of estimates for now as we collect more data, as we become more sophisticated. How have you built into these standards this challenge about forward-looking information? And secondly, at the end of your presentation, you talked about yet another type of taxonomy, the tagging, digital technology to tag information. How can the digital transformation contribute to a more credible delivery of forward-looking information?
Okay. Now, regarding, well, first of all, it's a very distinctive feature for sustainability. There are features for sustainability reporting. Forward-looking information is very distinctive. There are other elements like the role of narrative information in financial reporting. It is most of the time a comment, contextual information to understand figures. In sustainability reporting, it's autonomous and it has a value per se. So forward-looking narrative information, different units of accounts, this is creating an environment where quality reporting needs to take on board those different characteristics. So forward-looking for us is a matter of transparency. You know how people can be cautious about giving predictions in the financial reporting side. So it is a shift of paradigm here. So we have to be careful. However, sustainability is long-term goal. So if you are not providing forward-looking information, you do not meet the expectation. Now, people should not interpret forward-looking information as they do interpret backward-looking information, because backward-looking information is history. Forward-looking information is prediction. Educated, standardized prediction. So on many topics, what we insist, first of all, I should have mentioned that a static description of the relationship between businesses and sustainability matters is interesting, but it's not what is expected. What is expected is really the trajectory that the company is contemplating. So in that regard, forward-looking information is certainly addressed by the ESRS and, by the way, by ISB on climate. We try to define what would be a proper forward-looking information, insisting upon targets, policies to implement targets, action plans in place, and the assumptions that are used to establish targets and pathways. So, you know, transparency is a key word. You need to explain what you intend to do and how you will intend to do, bearing in mind that, of course, this is an adaptive environment. And there is one other characteristic of importance, is that financial reporting is restricted to the entities under your control. In sustainability reporting, you have to identify your impacts, risks, and opportunities in the value chain, upstream and downstream, which is not, of course, easy. So that's where estimates, proxies, sector data is useful. And we were just discussing this morning how to make it at the same time effective without burdening in a stupid manner businesses, because, you know, collection of sustainability data from the value chain in you know, number 10 tier of suppliers is not realistic. So that's where the collective effort of sectors to establish proxies and stats is going to be critical. But on the other hand, you cannot ignore that many risks and opportunities arise you know, beyond your own operations, and that you have an influence on your upstream and downstream value chain. Regarding digital taxonomy, 2 points. I already mentioned that it was highly critical to have the digital language ready as soon as possible. And by the way, maybe 3 points, one more. We have already agreed with CDP, for instance, on climate-related disclosures, to have ESRS as an entry point on CDP, because, you know, we want ESRS reporters to have the easy way to store their information in line with what they will have prepared under ESRS, point one. We have also worked hard. I am a member of the steering committee of NZDPU, the Bloomberg Macro Initiative to establish a public utility storing basic climate related data worldwide, because we feel that access to information is important. In the EU, ESAP, European Single Access Point, it exists and will encompass sustainability reporting information. I would have preferred that to be the case from the very, very first reports. Due to the complexity of the matter, it will be probably 2026. Now, the tagging is ready. So you will be consulted. I mean, public consultation will happen at the beginning of 2024. We have identified the tags that correspond to the data points that I was mentioning in my keynote speech, and more, because, you know, we have the quantitative ones which require more detailed information. And I strongly recommend that preparers, when they prepare the human readable report, think about the list of data points on the one hand and the tagging on the other hand, because they will quickly be expected to store the information under a digital format, which, by the way, is the one that is used by stakeholders. The human readable requires a lot of effort. You can't read long text blocks. you want to access some information. Artificial intelligence may help, but also good tagging is certainly a good way forward.
Thank you, Patrick. And before I come to you, Stephen, because I think a lot of the interesting points that Patrick raised around supply chain management and so on are key to the conversation with you. Patrick, I just want to take one follow-up question because I'm conscious that you will need to leave at 12, and I just want to
Yes, thank you very much, and apologies for that.
Not at all, but I wanted to ask you one small factual question, which maybe you presented and I missed. On the international consistency and the work you're doing with the ISSB and GRI, you're working on the mapping, of course, as to where the two standards are consistent and where the European standard goes beyond. What can we expect on that work on mapping? Because that's, of course, internationally very interesting.
Okay, we regarding GRI, we're already published what we called an interoperability index, which will be submitted to approval to our board this afternoon, but which I think is a no-brainer and which highlights the high level of commonality achieved. So the 75–80% of commonality, because certain matters are not addressed by ESRS, like tax and things like that. But, you know, we have a high level of commonality, and the document is already available and will be publicly available as approved, I hope, in the coming days. Now, regarding the ISSB, we are almost near the finish line, I would say. We had meetings at the end of October. Then COP28 created a little level of busyness for everybody, and but we have received just a couple of days ago a new version of the document that we have agreed to put together jointly. And so that will be available beginning of January, I guess, bearing in mind that already in July 31st, when the Delegated Act was adopted and published, we made publicly available our assessment of the level of commonality and the fact that, you know, except for maybe a couple of information, ESRS incorporates all the disclosure requirements that are needed under ISSB. So I reiterate my personal assessment that, you know, an ESRS reporter would be okay not to have to report and to prepare another independent report, and the information would be available in the ESRS report, and via digital tagging with what I call an earmarking system, I think you could isolate the ones that are limited to the ISSB ones.
Thank you very much. It'd still be interesting to see that document because there's, of course, people also providing services and goods into the EU, and they have to kind of map it the other way around, so to speak. So, no, thank you very much. I do want to come back to you, Stephen, because I thought it was interesting how you said you would use, you're thinking on are using transaction data to help in the supply chain monitoring of emissions and environmental standards. Obviously, that helps to with a reporting framework that cannot be, as Eugene and Patrick said, static. But I'd love to explore it a little bit more, what potential you see there, how it helps with transition pathways as a kind of dynamic element. And obviously, where do you see in general some of the barriers, remaining barriers to the implementation of non-financial reporting in this area?
Yeah, great. Thank you for the question. I'll answer that and then maybe pick up a couple of the other points that folks made, connecting the dots as we start, you know, with the data and the transaction information. I think what we're seeing is the most, I guess, advanced, or the people that are seeing the most as an opportunity are starting with this measure position, but quickly moving to a decarbonization plan and then looking for the opportunities to change what they're doing in their business to improve not only their carbon and their environmental position, but just as the running of a business. Within the supply chain, as money moves, particularly if you know the code or the area in which that money is related to, it is a good first starting point. And as the famous Peter Drucker quote, you sort of manage what you measure. And I think an incredible amount of shift happens quite quickly. So maybe picking up on a couple of the other points is the acceleration happens as soon as people have that first point of view. In terms of forward looking, I think what we're seeing most is that the environmental risk, understanding this carbon and emission risk is equating now to credit risk. And this is where not just in your supply chain and how you're deciding to work with different people, but if you take a bank's perspective, how the bank is now deciding who to lend to and how to lend to them, and understanding their entire portfolio. It's not to say a pressure on business, but I guess the opportunity on business is this is coming from so many different sides now, whether it's the consumer that's looking to better understand their own footprint and who they buy with. Governments are trying to understand emissions and their overall footprint. So while the end goal or one of the end pressures right now is around regulation, when you see it as in my operating environment or the ecosystem of commerce and the way that I do business, if I don't have a good handle on this, I'm going to miss out on opportunities, to work with others or work differently in just the way that I operate my business. Again, transaction data, starting point, moving into all money flows, then moving into activity. It is a journey, being more and more data-driven, making it more and more automated. It just gets you past that first point. As long as you're aware and you understand that it is the starting point, that you need to delve deeper from a resolution perspective and an understanding.
Thank you. It's interesting you make that point increasingly between ESG risks and the provision of credit or credit approvals. We actually did some work around that in the summer, and one starts to see this becoming incrementally more and more sophisticated. Maybe to close the panel, obviously going to you, Sean, and then to Eugene. Sean, we talked about kind of, again, forward-looking information, estimates. Just now, Patrick was saying that information has to be put, non-financial reporting has to be put much more into its context. And you said, well, it's no longer creative writing, we're moving much more to a kind of standardized approach or more sophisticated approach. But I'd be interested to hear how you see your clients dealing with that challenge of estimates, but also, obviously, I'd be interested what expectations you see for the assurance process or the audit process at the end to provide an additional layer of credibility to forward-looking information.
Sure. So maybe to start with the assurance piece, obviously through CSRD, one is required to achieve limited assurance. So straight away, that's putting the information and obviously the disclosure on a completely different footing than we're used to. And obviously the view is that will move to reasonable assurance in time, and there's quite a short timeline be given there. And obviously there's a lot of work going on behind the scenes with IASA in terms of formulating those standards. But from a standing start, limited assurance is a requirement. And again, this is all with a view to make the non-financial reporting or your sustainability statement and put it on an equal footing with your financial reporting. So that's very, very welcome. What that then does is it moves the information into a whole new space. So gone is the days of creative writing. And then one has to think through very, very carefully in terms of what data sources they're using. And again, we're seeing a move from proxy to actual where applicable. And I think the CSRD has been cleverly designed when one thinks through the value chain, and they've taken a very pragmatic view in allowing up to 3 years to get those information sources, because that brings more actual data in, and it allows one to create the right data architecture and infrastructure. So I think those points are all very welcome. From a financial service perspective, this is already starting. So they're not waiting to see what the outputs look like. Remember, they have to produce their own reports, but equally they're going to be a large consumer of that information. And already we're seeing that in terms of risk appetite, so where they're willing to take risk. their capital allocations. Of course, we can see lots of announcements in that space, but maybe more importantly, how they're operationalized in terms of the transfer pricing and so forth. So again, that's a really important point.
Good. Good. So quick confusion there for a second. Eugene, because I realize you also have to leave. And in effect, I wanted to give you the final word. But apologies, Sean. I appreciate what you said on the assurance side. I didn't respond quickly enough. It is an important aspect. It'd be interesting to see where the standards will go, the international standards, because what we hear now in Europe is that Europe will not adopt the standards as such, but will develop their own European standards, which I find from an international perspective rather concerning, to say the least. But Eugene, maybe the final word to you. I'd be interested, you heard about international consistency from Patrick, but I'd be interested not just in international consistency on non-financial reporting, but also greenwashing. How do we get to a more consistent approach on greenwashing?
Right. Well, I think there are many aspects of greenwashing we have to look at. And in fact, one of the aspects being greenwashing actually has arisen because of the need to make disclosures. And sometimes it's a lot easier not to disclose if you're not sure, if you can't, you're not confident of meeting the particular targets. So this is a problem we have. If disclosures are voluntary, they're not mandatory, and at the same time, we don't provide safe harbors, which is dangerous in some, in some respects, you will get greenwashing. But I think what we need to do firstly is to understand that we need a universal baseline. So while ISSB may give us a global baseline for the capital markets, we have to add on a lot more. And we are now not dealing with just universal owners, we're also dealing with a universe of stakeholders, and all of them require some of the similar information in a slightly different form. So the first thing we need to do is get consistent stakeholder baseline information out. That information needs to be compiled in a consistent way, it's relevant, it's credible, and it's comparable. And again, coming back to the point of the assurance, if there can be an assurance overlay, that would even give more confidence. The second is that I think with combating greenwashing, it's not necessarily just a financial sector issue, because we've got different types of greenwashing. So if you have, say, for example, green lighting, which people actually highlight the good things they do and not so much the bad things, then you need advertising and conduct authorities to come in. Green rinsing, where companies actually change their estimates, that can actually be dealt with through proper sustainability disclosure standards. Green crowding, where people hide behind the performance of a group, that can be fleshed out when you have to do individual reports. So the way to address greenwashing, obviously the first is to have a proper stakeholder baseline, a universal baseline where you can use for multiple purposes, to have the coming together of different types of enforcers. So whether it be the market trying to enforce, whether it be advertising and conduct regulators, for example, working with financial regulators. And you have to increase capacity, because I think many people actually greenwash unintentionally, and that could be quite unfair. So we may also need to do that. Another point that I have to raise is that as you build just transitions into various sustainability actions, you also need to make sure that these just transition actions don't end up being greenwashing. So we have to have a multi-pronged approach to this, and there's no one single solution to address greenwashing.
Thank you. What I take away from the panel, whether fairly or not, is that, as Patrick pointed out, we need to have a much more robust framework around the governance of individual companies and how they provide information. But what gives me great hope listening to you, Sean and Stephen, is that we're really on a path towards collecting more credible data points. It's not just about the governance, but also actually finding ways to collect credible and measurable data and moving towards the assurance of that data as well, be it through the transaction framework or be it through credible data points actually delivered by the companies themselves. And that's interesting, because I think a year ago we wouldn't even been at that point. It's interesting how within 12 months the debate is moving on, and it'd be interesting to see where we are in another 12 months. I really appreciate it. I realized this panel was slightly sandwiched But I think it was a fascinating discussion, and I hope we can welcome you all back again.